Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the week ahead. Now, what a difference a day makes. After I did the show last week, almost as soon as we pushed the show out, Donald Trump just pulled the rug from underneath the whole of the market. And what he did, he started to rock the boat once again regarding the trade war. So if you would have probably seen the headlines that Donald Trump decided that he wants to raise tariffs again on US goods to the value of $300 billion, which he wants to put a 10% tariff on that. Well, you can imagine what that did to the market that had been thinking that Donald Trump had stopped rocking the boat and was largely just obsessed with what the Fed would do and earnings. Now, the market immediately went into panic mode. So just to give you a quick recap, the Fed the day before had said that the market, it cut interest rates, and it had said that the reason that they would cut rates further, they hinted at the only reason they would do it is if the trade war escalated. And of course, Donald Trump is a real advocate of cutting rates. He wants the interest rates cut in America so he can compete with China and to keep the US economy boosted from the effects of what he's doing with the trade war. Well, one day later, he basically tested Jerome Powell, that's the chair of the Federal Reserve, and re-escalated the trade war. So markets immediately fell. There was the worst day on equity markets of 2019. That's how bad it got. Now, in the aftermath of that, we saw the VIX, that's the fear index, spiked to over 20. It's now currently at 22. If you look at what happened in the rest of the world in stock market terms, we saw the S&P fall by 4.61%, the Japanese equity markets fall by 5%, emerging markets down by 5.3%, the tech heavy Nasdaq, now that was down 5.85%, nearly 6%. It was a tech car crash, and that is partly because there's the danger or the worry of disruption to some of the supply lines for some of the big tech companies. Think Apple in this regard. And Apple had just released its earnings the week before, which mostly was greeted as very positive. Their share price jumped, but all that was given back just because of the trade war escalation. We had in Europe, equity markets fell about 6%, and the big laggard was the FTSE 100, which was down 6.7% so far. Now, the FTSE hasn't had quite the buffer that it had before from the pound. The pound is still down towards $1.22, sometimes creeping a bit below that because the Brexit fear is still there. Nothing positive is really happening. We've had headlines to suggest that Europe isn't prepared to renegotiate the deal with Britain. And of course, all we've had is more and more talk of a potential no deal. So as we stand, the pound is staying weak, but hasn't actually weakened anymore until we get some more detail. But it wasn't just what Trump did that really got the market worried. Those numbers I just mentioned on what the stock markets have done are up to the point of this video. What really started to kick things on a second leg downward was when China decided to retaliate. Now, China has got lots of things up its sleeves it could do. It could start to sell US treasuries, but one of them is devaluing its currency, and it did that. Now, China is very particular about its currency. The People's Bank of China will set the exchange rate between the Chinese yuan and the dollar. And there's a number 7, which is largely put as a bit of a benchmark. It's not one that is stated officially, but it's a level at which the People's Bank of China has defended. Now, a weak currency, of course, is good news generally for an economy that's got sort of export-led, like China has, because it makes your exports cheaper. But on the whole, you don't want your currency to weaken too much as you start to import inflation, but also you get something called capital flight. So if investors become spooked or other currencies and economies seem better, more attractive, then they'll start taking their money out of China and moving it across to, say, America or other developed markets. And of course, that is bad for your economy. Well, China decided to devalue its currency, and it was the first time it actually hit this level. It'd gone above the 7 level, so it actually weakened it to the point that you could get more Chinese yuan to the dollar. It weakened it to a point that we haven't seen since basically the financial crisis, and that was seen as a direct sign of them escalating the trade war. So they were doing a bit of a tit for tat. They hadn't imposed tariffs, they'd weakened that currency. And that really did spook the market, which is why we saw the big spike, which is why we saw equity markets tumble. And it's also why we saw bond markets rally. Now, if you're holding treasuries or you're holding any form of bond, then you've done pretty well this week. In fact, you've done brilliantly. We're at the point now where US treasuries are better returns year to date than the S&P 500. So treasuries are doing better than equities at this point in time, and that's because they've been a haven bid. As people have got scared, they're rushing to buy haven assets. That means gold, that means the dollar actually, but that's also meaning treasuries and other types of government debt. So if you go around Europe, you will see there is so much negative yielding debt. So that means that you'd have to pay many of these governments to invest, to lend them money basically, which is an incredible situation. It's only escalating, but it shows you what a strange world we're in. So with equity markets now tumbling, where is the bottom will be the next question, and we don't know. But one thing I would say, go and look at what happened in May. The last time Donald Trump had a trade war tantrum, as it were, was in May. And what happened then? We saw equity markets fall by just under 7%. So if the market repeats that pattern, then we could be soon finding the bottom, but there is no certainty to that at all, because it very much depends what happens in the coming weeks and months. Now, one thing that did happen in May, it paid to be defensive. So that means defensive stocks, that means things like REITs, that means things like utilities. And in the last few days, they've started to pick up again, because in July, when risk was rewarded, those sectors lagged. But at the moment, all those sorts of sectors which are exposed most to the US economy and the global economy generally, so think about consumer discretionaries and financials, they've started to lag. So with bonds absolutely crushing it right now, the other thing to make note of is that the inversion of the yield curve, this is something we've talked about on previous episodes. If you haven't listened to those, go back and have a listen. But what you need to understand or just grasp quickly is that there are certain recessionary indicators that suggest we may have a recession in the coming months or years. They are flashing red. So we've had an inversion of the yield curve all over the place in bond markets. And so we are looking now at the possibility of a recession. The market's pricing one in. Whether we get there will depend on central banks. Now, today we've had central banks in New Zealand, we've had them in India, we've had them in Thailand, all cutting rates more than people had expected. They've been taking action. Now, in the developed world, we're looking at what the Fed will do next month. If you recall last week, the Fed cut interest rates, and there was a suggestion they may not cut them again for the time being. But now the market is pricing in a Fed cut in September. Well, the odds are increasing at least. So to sum up this week, earnings are still they're doing better than people had expected. That's a big tick. The Fed had cut interest rates. Central banks are accommodative at the moment, but with the trade war now suddenly reigniting, things are looking decidedly dicey going forwards, and we're going to have to see what happens in the coming weeks and months ahead, and in particular what central banks do. So that is it for this week. If you want to get in touch, you can do so in the usual way, Damien at moneytothemasses.com, or via Twitter, moneytothemasses with the number 2, and of course on Instagram, moneytothemasses. Until next week.